Hi everyone, August Biniaz here with CPI Academy. I'm joined by 𝗖𝗽 Benesocky. Welcome, Eva.
Thank you, August.
We host the CPI Academy YouTube show dedicated to adding value to our viewers' investment journey. We bring on experts to discuss all topics related to real estate investing. So we hope you enjoy it and share and like and all the other good stuff.
Thank you, August. Hello, everybody. Today we're joined by Rob Beardsley. So welcome, Rob.
Welcome, Rob.
Yeah, thanks so much for having me.
Amazing.
Awesome.
Rob, why don't we just start off by you telling our viewers a bit about yourself? That would be great.
Sure. My name is Rob Beardsley. I'm the founder of 𝗖𝗣𝗶 Capital. We're a just over 3-year-old owner-operator of value-add multifamily in Texas. We particularly specialize in workforce housing, kind of in that C+ to B- space. We like underperforming properties where we've had great success turning around assets that are 50% occupied, 70% occupied, 80% occupied, and take those assets and bring them to stabilized occupancy while raising rents, curing deferred maintenance, improving management. So those are the types of opportunities that we're attracted to. Prior to forming 𝗖𝗇𝗏, I grew up in Silicon Valley in Northern California, grew up in a real estate family. My parents ran a 30-year residential brokerage firm buying and selling luxury homes for their clients, as well as doing their own personal flips and construction projects, but never actually got into the business of owning assets to build wealth. And that was one thing that inspired me as I saw how hard they worked, but never really had built wealth from that work. And so that was something that I wanted to do that differently, which is actually have my work contribute to the accumulation and appreciation of assets. So that's part of my journey here.
Awesome.
Incredible. Now, what interested you about multifamily and got you into the multifamily space?
Yeah, so growing up around single family, multifamily was very accessible to me, and I understood the sticks and bricks of it. And as they say, if you can wrap your head around one unit, you can wrap your head around 100 units or 1,000 units. And so, I really believe that to be true, and that's been why it's been an easy way for me to break into the space.
Incredible. Now, Rob, we know that you're somewhat of a thought leader when it comes to multifamily deal analyzation and underwriting. What was it about underwriting and analytics that interested you?
Yeah, I'm a numbers guy. It's growing up, I hated to write, and I hated things that didn't have a single right answer. And so it's funny now because I love writing now, and write articles. I wrote a book, so writing's fun now. But I used to just be a very black and white person, analytical person. I just liked numbers, and I still do. And so that's what initially attracted me to the underwriting side of the business, because it's obviously it's just numbers driven, it's analytical, and it's kind of like problem solving a bit. It isn't quite just like true math where it's just black and white, you either got the answer right or wrong. There is nuance and there's subjectivity, but that's what makes underwriting a very fun skill, because you're always trying to master it and improve your subjective understandings of certain deals. So that is I went straight there and never looked back.
Awesome. And I just want to touch a bit on the item 𝗖𝗽 mentioned, at the thought leadership portion of it, where obviously you manage a firm that focuses on the value add model to acquire multifamily assets, but you're also assisting groups like us or different levels of in multifamily investors in the process of underwriting. I believe you've developed your own deal analyzer. I know about this because I reached out to you for assistance in the underwriting process when our firm was in need of that. Talk to us about the thought leadership portion of it, but not only that, but also, do you offer, talk to us about, the thought leadership process when it relates to underwriting in particular, if you may.
Sure. Yeah. So as you mentioned, there's the model that I've been building and rebuilding over, really the last 4 years now is a great, it's a very important tool that we use every day, But for thought leadership, it's been a very valuable tool as well, because it's a valuable analyzer that is available for free. And so that's unique, and people are excited about that. And so that's been a great way for me to build relationships and build my network, because it's attracted so many people to us, and they've gotten to learn how we look at deals. Because, in addition to that free model, I obviously put a lot of free content out there on social media, and then kind of going up the ladder, I've got, about almost a year ago, I came out with the underwriting book called The Definitive Guide to Underwriting Multifamily Acquisitions. And that was a really great move, because it finally was a place for me to solidify my thoughts, because I kept getting, everyone would download the model, but then they'd say, how do I use this? Or what does this mean? Or I think I broke it. Or for this special circumstance, what do I do? And so finally, I created a piece of content that covered, 90% of those bases. And that's been a really great way to help people, and again, to grow my network still. And as you mentioned, along the way, I've done some underwriting advisory for certain clients, or help them. But really, my main focus is, as far as helping people, like you mentioned, is through the content, through the book. And I launched a mentorship program. So I'm doing one-on-one mentorship, helping people, not just with the underwriting, but with helping them, start their business, helping them raise capital, put the partnership structure together, source deals better. And that's been really successful. My clients are going from no deals to closing deals, and it's super exciting to see that. And some more exciting things to come, as far as helping people with, a mastermind group and an underwriting course. So those things are all coming, and I'm excited to keep on growing the network.
Absolutely.
That's incredible.
That's amazing. Yeah. And, most of our viewers may know, we're located here in Canada, and our company's focus is in the US, acquiring multifamily assets in the US. But when you talk about a model, now a lot of people who might be new to real estate, or they've invested in real estate for single family, even if it was a fix and flip or project, they might not be very familiarized with this idea of a model. If you could kind of touch on that, what is exactly a model or a deal analyzer, which, if you could touch on that. And also, the great thing is, for viewers who are in Canada, who want to, certain items, when we bring on a securities lawyer in the US, Canadians can't really use that securities lawyer in Canada if they're using for security purposes. But when you talk about financial modeling, doesn't matter where in the world you are, numbers are the same. And Rob's financial modeling can easily be used here in Canada, and I'm sure adds lots of value and other content he provides. But please go ahead and describe what is a financial model in as much detail as you can, please.
Yeah. So it's everybody has one, and everyone's is different, but it's all doing the same thing. And the purpose is simply to take in all of the data related to the deal: purchase price, revenue, expenses, debt, growth, renovations, and compile all that into some sort of analysis, which most commonly is in the form of an Excel spreadsheet, or any spreadsheet that you're comfortable using. And then it, through all those inputs, creates projections about future results, which include annual cash on cash returns, total returns through an IRR, an equity multiple, annualized returns, and then risk metrics as well. So that's really the simplest thing. And at the end of the day, why are we modeling to begin with? It's to identify whether a deal makes sense. At the end of the day, it's, for the most part, just a tool that helps you make a yes/no decision. So yes, we like modeling, and yes, we like to make it complex, and it is complex at times, but at the end of the day, it's most of the time just a yes/no tool. Here's the price, here's the deal. Do you want it or not? Yes or no. And that is, that's why every person, if in investing, has, and if they don't, really should be using some sort of model that is consistent across their deals, so that they're comparing apples to apples.
For sure. Unfortunately, there are times I've seen bigger groups which don't even have a financial the deal analyzer, especially not as one as sophisticated as the one you give out literally for free. But that's truly incredible.
Yeah, definitely. Now, you know what? You're not only a thought leader, and I was going to say he's really great on the underwriting part, but you're also a apartment syndicator. So maybe you can talk to us about the deals you've been involved with and how that all came about.
For sure. And if I just briefly touch on that, this idea of apartment syndication or multifamily investing, it is definitely a team sport. It's there's different persons within the group who are great at certain positions. Obviously, with your thought leadership and with your wealth of knowledge within analyzing, so it's obvious to guess that is what you bring to, if there's a group that you work with or your internal company, that's a very important part that you play in. But tell us more about your company as an actual syndicator or as an actual operator. Tell us about that and how it started and everything else.
So yeah, like you said, syndication is absolutely a team sport. And so with our company, Lone Star Capital, my business partner, Kent, and I, we founded it just over 3 years ago. And he brings more of a legal and operational background. He was formerly a tax attorney, and he really leads our asset management and operations. And on my side, as you said, I'm on the acquisitions and capital market side of things. So it's for me, I'm always looking for two things: deals and money, and trying to make a match as well. And we also have a director of acquisitions, and so our director of acquisitions, he has taken a lot of the burden or the effort from me required to source deals every day, underwrite deals every day, and submit offers every week. And then that has freed up my time to take on a very important role, which is often overlooked, which is raising debt and equity, and particularly equity, because there's certainly raising debt is time intensive and complicated, but raising equity is a lot of the magic in the deal. And so one of the ways that my analytical side and the thought leadership has translated very well is that I because I have worked so hard to become an expert with all the little details, I'm in a really good position to then explain things as simply as possible to potential investors and to partners. So when they come back at us with an army of questions about a deal specifically or something, I'm in a great position to respond back and give them that confidence they need to move forward and partner with us.
Great. Awesome.
That is fantastic. No, it really, your background really would be great on the helping out the investors' questions that come along. How do you nurture? You said that your big part of it is raising the capital, raising the equity. How do you nurture your investors
or potential investors?
Your
database, I guess.
Yeah.
Right. Yeah. So I think one of the foundations is a monthly newsletter. I think that's really important. It's just a way to, monthly is not all that often. It's just enough to remind people that you exist. Anything less than monthly, they kind of forget. But monthly, it's almost frequent enough where they can kind of expect that message to come. And as long as your message is good and it's of high quality, it'll be well received and people are excited to read what you have to say. And I really strive to say what's on my mind and write something thought-provoking that people will either agree or disagree with. Either one is fine, because it's a great opportunity for both sides to learn. And so the monthly newsletter, which contains a lot of my current thoughts and ideas about the market, about deals, is a great way for me to keep in touch with everybody and nurture. And I think from there, it's just adding on some of the great things that, like, you guys are doing this webinar, for example. I think webinars are potentially the number one way to attract new potential partners and investors. And so that is really valuable.
That's great. And you're definitely a common face on many different platforms, podcasts, YouTube shows. We knew about you prior to looking for an underwriter or assistance in underwriting, and that's how I got connected with you. So you're definitely out there. You also speak as a I'm not sure as a speaker on many actual multifamily events. I've seen you on as well. So kudos to
He's
you.
everywhere.
And you're everywhere.
That's what happens when you're a very smart, intelligent young man.
Exactly. And talking about young man, how old are you, if you don't mind me asking?
24.
Wow.
Yeah.
Okay.
And you started your company 3 years ago. Good for you.
Wow.
Good for
Okay.
you.
I don't know what I was
That's really
doing when I
cool.
was 24 years old. God, 21? Oh my goodness. All
Good
right.
for you.
Great.
Thank you.
Incredible. Now I'm excited to get into this next part because I want to start talking about cap rates a little bit, if you don't mind. We know extremely important and crucial indicator when analyzing a multifamily deal is the cap rate. So maybe you could take a few moments in detail and explain what is a cap rate and how it affects the underwriting process.
Yeah. So what I do love talking about cap rates because they are so simple yet so complicated. And the reason why is because the formula itself is quite simple, and it's one of the first things you learn when investing in real estate because it's one of the most fundamental measures of return potential. And so for those that are unfamiliar, a cap rate is simply your income divided by your purchase price or your value. So it's just those two things. Very simple. But the reason why it gets complicated is because we start digging in deeper and we ask, well, what income? Is it the past 12 months income? Is it the future 12 months income? And is it adjusted for certain, expense adjustments that you may need to make? And then on the value side, I would say it's probably a little more straightforward. You've got your only options for value are your purchase price, or you can add on your renovations. So for example, I'll just give an example to make sure that you value things properly. If we're going to look at, let's say, a cap rate type of equation, and we're going to look at what the future income potential is of the property, because we're less concerned with the current income oftentimes because we're looking at the future, at the business plan to get us to a future income. Now, if I take my future income and I divide it by just my purchase price, I'm going to get an unfair measure of yield because I didn't include the costs associated of my business plan. Because if my business plan included a $2 million renovation budget so that I could increase rents and get a higher income, I need to factor that into my cap rate equation. So it needs to be future income divided by purchase price plus my capital expenditures to get a more honest and fair evaluation of my return potential. So it's always making sure that you're comparing apples to apples and calculate everything. Another thing that is kind of interesting is you hear there's kind of two schools of thought, and there's like an old school real estate investor, which all they care about is the cap rate, the historical cap rate. And they just look at the numbers as they are and say, well, if the cap rate's not there, I don't like it. And then you've got kind of a newer school of investor that says, I don't even care what the in-place cap rate is because I know I'm going to raise rents and run my business plan, and that's how I'm going to get my return. And the real answer is somewhere in the middle. Neither approach is correct. It does absolutely matter what your going in cap rate is, but it also matters what your business plan is and how far you can push the cap rate. So you have to balance both.
Got it.
Great
Got it.
explanation.
So
Thank
something
you.
that, thank you. Something that me personally have had maybe difficulties with is I do understand the cap rate when it comes to an asset, whereas your NOI divided by the asset value, which provides your cap rate. But cap rate is also used in the context of a certain neighborhood. So this is a 5 cap neighborhood, or this is a 6 cap city, or this area is a 4 cap. It's Vancouver is known to be a 1 to 2% kind of cap rate city. So discuss that with us. How does that come into effect? And I guess when you have a cap rate that is in this estimated number that a broker throws out at you, and most times people have difficulties believing a broker, even though we both used to be brokers.
Yeah.
But the broker throws out a number at you. Now you have that imaginary number, the calculation there. You have the NOI that the seller has to provide to you. Those two numbers should tell you what the asset is worth, and it usually does. But how does that all work? And yeah, walk us through that if you don't mind.
Yeah, so you're bringing up my favorite variation of the cap rate formula. So the standard cap rate formula that people learn first is simply cap rate equals NOI divided by purchase price. But if you just flip the variables around and you put value equals NOI divided by cap rate. And like you said, if you know those two variables, if you know the income and you know the cap rate of the area, like you said, then you can come up with the value of the property. And that is obviously very important. And so when we talk about different areas, we're looking at the comparable properties and what the market is trading for. So if we see that properties of this type, this certain building class, built in the certain age range and has, certain income levels for the residents and growth dynamics, there's all these variables about a market. Analyzing a market is way more complicated than analyzing a deal. But basically, given all those variables, you can, like the broker says, oh, this market is a 5 cap area. And that's really important because you need to know what your potential income is worth. Because in the abstract, a cap rate is meaningless. If I told you, hey, I'm buying this deal for a 6 cap, we don't know if that's a good deal or not because we don't know what area it's in. So in some instances, having a 6 cap would be just a home run deal all day long. But in other instances, a 6 cap could leave you, with losing money on the deal and eroding value. So the key is to make sure that, kind of how I was going back about your future income divided by your purchase price plus your capex, you want that number, which is your future operating cap rate, to be greater than the market cap rate. So that way you're exiting positively. Otherwise, you didn't create value at the property. And that's the issue when people rely too much on their business plan, right? And they say, well, look, this deal's a great deal because I'm raising rents from $800 to $1,000, and that makes it a great deal. Well, my argument is, well, if you paid a 3 cap for that and you raise the rents $200, you might only be pushing the cap rate to 5. And if the market is a 5.5 cap, you actually didn't create value. You could have just bought a stabilized deal at 5.5 right from the beginning and avoided that whole headache of raising rents and renovating and all that. So you have to be aware of what cap rate you're building to in relation to your exit value. And that's why people really stress exit cap rates in their underwriting, because it determines so much about the potential returns.
Got it. Great point.
Very, very smart.
Yeah, and that's why it's very important to have either a strong external underwriting team or internally having a strong underwriting team, because all these, a half a percentage could mean so much, and understanding is very important. Now, there's one more item about the cap rate that initially confused me and caused some difficulties, and it does cause some difficulties for others, is that areas that tend to have strong growth and appreciation and are great places to invest in, like the Vancouvers of the world, like California, like New York, they all have very low cap rates. Now, areas that are maybe not a very good neighborhood, maybe there's high crime and other issues, they have high cap rate. But as far as a calculation, a high cap rate always it works out better in the calculation, because a high cap rate allows that difference between your expense and your income. But it's kind of a bizarro world where you're hoping, you're planning to buy at a high cap rate to bring it down to a low cap rate, but then you still got to watch for the neighborhood cap rate, because you can't have a low cap rate in that neighborhood cap rate. So it's like the same number all over the place. So if you just briefly want to touch on that.
And that's where it gets really complicated, trying to compare apples to apples, because like I was saying, a 6 cap in one market is a good deal and it's a bad deal in another market. And who really decides whether it's a good deal or not? I mean, it really is up to you, and it's hard to make those decisions. And a lot of people, especially where we are today in the market, where things are very competitive and there's a lot of investors competing for deals, people start to what they call chase yield. And so they'll look at places that they wouldn't look before, right? If an ordinary investor would just ignore that high crime neighborhood, now they might look at it because it does have that higher cap rate and they're being outbid in the more quality areas. And so they go out there chasing yield. They're taking more risk. They're trying to go out to where they can get that higher cap rate. But is it really worth it? You know, if I, as an example, if I can, let's just take like, you know, Dallas in Texas, which is a primary market, one of the hottest markets in the country. If I can buy a deal, I mean, realistically at a 4.5 cap in Dallas, or if I drive 2, 3, 5 hours outside of Dallas to go to a small market and I can buy a 5.5 cap, is that worth it? Is that extra 1% on the cap rate worth it? You have to make that decision. A lot of investors are doing that. But then what happens is all the investors, they go pile into that smaller market, and all of a sudden that 5.5 cap market becomes a 5. And then you look at the difference between Dallas and the small market as only 50 basis points or 0.5%. And you might go, well, gosh, I might as well just take the lower return, the lower cap rate in Dallas, and call it a day. So it's that incremental risk premium, which is you have to make that decision for yourself. Is it worth it? And so it's the risk curve all along that spectrum. Cap rates get higher, but also the risks get higher. And the main risks that build into a cap rate are growth potential, right? People are willing to pay lower cap rates where there's growth, because if I buy a deal at a 4 cap, but rents are just growing every single year, then my 4 cap, without even doing anything, is going to go from 4 to 4.5 to 5, right? And so investors love that. So they're willing to pay going in a low cap rate because they know eventually it'll make up for it. And then the other thing that you're getting a higher cap rate for as you go to smaller markets is liquidity premium. Because if you're in a hot market like Dallas again, if you want to sell your asset, you could sell it tomorrow because there's a million investors that want the deal. But if you're in a tiny market, it might take you 6 months, a year to sell, or it might never sell if you might get caught in bad timing. And so people are willing to pay lower cap rates for where there's liquidity. The best example of that is the stock market. If you look at REITs, for example, which are real estate investment trusts, which are publicly traded equivalents of real estate portfolios, people pay 2 caps for those. Whereas the same real estate, if you bought it not in the stock market, but just privately owned, would be a 4 cap. So people are paying double the price to be able to buy and sell the stock however they want. So that's the liquidity premium that is associated with cap rates as well.
No, you understand why I get so excited with the tokenization of the exempt market of
Yes.
of the shares. So that creates liquidity in our world, which liquidity doesn't
the future
exist.
of real estate.
Yes, but we won't get into that topic
Yeah,
today.
let's not get into that topic. I want to ask a really cool question for you. As August was mentioning, we're based out of Vancouver, Canada, with cap rates at 1 to 2%. Now, which is California times 2, essentially. Now, let's talk to us about the cap rates compressing in the US, and how do you see this affecting the multifamily syndication world?
So cap rates have been on a secular compression for, I don't know, probably the last 40 years almost. And they've generally followed interest rates. And so if you look at interest rates, they peaked in the 80s, and then they've just been on a steady decline. I mean, yeah, they have cycles, but that cycle is still a general downward trend, and cap rates have followed suit. Another really big thing that happened with real estate, especially multifamily, is the inclusion of real estate in institutional investment. So like if you were to survey pension funds in America in 1990 and ask them what their allocation to real estate was, it was like 5% of their portfolio. But today it's probably 25%. So all this new money has just been flowing and flowing and flowing to real estate, and that flow of funds drives down cap rates. So we've seen secular shifts in cap rates over time due to interest rates and due to global flows of capital. And in between, while all these major mega trends are happening over decades, you know, there's these little ups and downs. Like we had 2008, which was a big up and down, right? That was a big down. And even like if you zoom into a micro market, like in our market of Houston, with the oil crash in 2014, Houston had a little recession and cap rates went up. So there's all these little ups and downs, but the big trend is downward. And so right now we're at a period where cap rates do feel very low and compressed. And so you wouldn't be crazy if you thought that cap rates were going to go up just a tiny bit in the next few years, because there's some upward pressure on interest rates right now due to inflation expectations because of all the fiscal and monetary stimulus. But at the end of the day, we're still continuing along this mega trend of downward cap rates. So that's kind of my zoomed in and zoomed out take on that trend.
Well said.
Well said. Well
Very
said.
cool.
And people from us being from Vancouver and being myself being in a couple of cycles already here, and people calling Vancouver a bubble well over 10 years ago, where the cap rates were much higher. Now that the cap rates are below 2%, the people who were predicting that this be a bubble, it can happen, and I'm predicting it will happen in the U.S. as well, especially in places like Arizona, Phoenix, where people can't get enough of moving to that state.
Yeah.
And certain parts of Texas, also Florida. There are certain places in the U.S. where it's just a no-brainer. When we look across the border, where the median home price here in Vancouver is $1.4 million. When we look and people can buy a place in Florida and be minutes away from the beach with perfect weather almost all year round for $200K, it just, it boggles our mind. So, great conversation there. Really appreciate it. Now, I wanted to kind of also maybe briefly bring the focus back on your entity. Obviously, it's especially for a firm like us, where we bring on experts to be our underwriters and deal analyzers, but a firm like you, having someone like yourself who's a wealth of knowledge, who is the underwriter. Talk to us about your group. Talk to us about your guys' focus. You say you're based in New York, but you also said we in Texas. So tell us about how that process goes. Talk to us about what plans you have for your company as far as growth, and how do you guys structure your deals? Tell us a bit about that, if you don't mind. Yeah,
sure. So as you said, we're based in New York City, but we're unique in that we take a very focused approach at investing in Texas. There's a lot of investors in Texas that are in Texas, that are around the country, but we are. But they're also typically also focused, like you said, on Arizona, Florida, Atlanta, the typical hot markets. But we took an approach and said we wanted to become market experts. We wanted to stay very focused. We wanted to build great relationships, know all the deals, know all the players. And so that's what we've set out to do. And that's, I think, really led to our success, where we're able to uncover that last additional deal that you wouldn't normally see. Kind of the way that we describe it is, it takes like an 80% out of 100 effort to get most of the deals in the market. You connect with the brokers, you talk to them, they send you the deals, and so now you've seen most of the deals. But to see that special deal, that extra one that only comes up once a year, that maybe just fell out of contract, or maybe you have a direct relationship with the seller, that takes that extra, that final additional 20% of effort to get that one special deal per year. And so that's what we really want. And that's why we spend so much time focusing on not being all over the country, but focusing specifically. And the other reason why being geographically focused is helpful is from an operational standpoint. Having your portfolio concentrated helps with management. And so we're currently in the process of building out our management infrastructure based in Houston, so that we can best manage our portfolio and get cost savings associated with managing assets that are close to each other.
Great. I could talk to you all day long. But,
I was going to say, I cannot wait to see your growth. I think that you're just such an intelligent, smart young man, and it's going to be great to watch him. When he's 30.
Using a stock market term, he's a blue chip prospect.
I love it. That is fantastic.
Okay, great.
Thank you for sharing all your knowledge.
Thank you for coming
today.
on. We'd love to have you on again and have possibly a Canadian twist on the YouTube show. Maybe we can send you to a multifamily deal, a 100 unit in Canada, and compare it to one of your 100 units in Texas, so people here can see what it was the reason that we literally left our careers to focus into the U.S., go through all the hurdles that exist with cross-border taxation and security commissions across the border and all the other issues we're going through, all the money we're spending to be able to allow Canadians to participate in the U.S. because of non-existence of deals and because of the low cap rates, which make deals into the negative cash flows here in Canada. So we'd love to
imagine us telling Canadians about deals just right across the border, about the numbers that are achievable. Their eyes are like really big, they get really big, their jaws drop.
Yeah, so we'd love to have you on again as soon as we can and kind of go over that. That'd be great.
Before I let you go, I'm going to ask you one more question, and that's a question we ask all of our guests. And it's, what is your best or number one advice that you would give to a passive investor or someone looking to start passively investing in real estate?
Yeah, that's a great one. So for me, I think the more you know, the better. And so, and there's a lot of momentum involved with that. And so it's very much, whether you're active or passive, it's very much relationship driven. So if I'm a passive investor starting out, I want to build as many relationships as possible. I want to get on everybody's deal list. I want to see as many deals as possible, because if you show me a deal and I can't compare it to any other deals, then how do I know it's a good deal? So, but if I have a deal and I can compare it to 10 other deals or 100 other deals, now I can start to understand whether this makes sense or this doesn't make sense. So by building relationships, you really achieve two things at once. You get those relationships, which are critical, and you're going to get deal flow from those new relationships. So making sure that that is in place will really help, not only for you to invest in the best deals, but also know what the best deals are.
Great advice.
Great advice.
Fantastic.
Yeah, that's awesome. This concludes our portion of the YouTube show. Please hold on for a moment here. But Rob, we want to really thank you. Appreciate you. We want to have you on again.
Thank you.
And
so
thank
much.
you.